Here we go. Today's chapter will be for the decision making. Before we start making decisions, we have to make a few things and I have to remind you a few things. First, we're reporting, as you said before, we're reporting for the managerial accounting purposes, means for the internal users of the company. We're not reporting for the external users of the company. So the reports that we're going to provide will be very, very specific for decision making and for the future of the company, rather than how to past events are presented on the financial reports. That's first. Second thing, what we have to remember is based on the different cost classifications, we have a different type of costs. Based on the where the cost is presented at first, we have two types of costs. We have a product or inventorable cost, also called, and we have a period cost. Product cost, which again goes first on the inventory, that's why sometimes it's called inventorable cost, is what will be that? That will be the total cost for the product, which the total cost for the product is direct material, direct labor, and manufacturing overhead. All those three costs are product costs. And all the other costs which exist in the company, we're going to treat them as a period, or they're going to go directly to the income statement as expense. That will be the sales administrative, shipping, and anything that will be directly expensed. That's first classification. Second classification is based on how the costs behave. And costs behave two ways. Either they behave as a variable cost, either they behave as a fixed cost. One thing we have to remember, and always you have to have it in your mind. First is, variable cost per unit always stays the same. Second thing is, fixed cost in total always stays the same. Keep those in mind and always have those in mind when we're making decisions. The next thing that we have to do is to remember the two types of income statement. One was the traditional, the other one was the contribution margin. Traditional income statement involved sales, cost of goods sold.
Professor, are you sharing the screen?
No, not yet. I'm just talking right now.
Okay. Okay.
No, nothing to share at this point. I'm just want to you to pay attention on what I'm saying rather than what you're saying. So you have two income statements. One is the traditional, which is sales, cost of goods sold, gross margin, and then we have operating expense, operating income, where the other one for the decision-making purposes, we're gonna call it contribution margin. Again, starts with the sales, but after that we split the costs only and only in two ways that they behaving, variable and fixed. Nothing more, no mixed cost, nothing in the middle. So after sales, we're going to deduct the variable cost. We're going to come up with the contribution margin. After the contribution margin, we're going to deduct the fixed cost, and we're going to see how much left in the company. Is the operating income? Is it not operating income? So having those in mind, let's start digging now in today's chapter. Decision making. So for the decision making, those are the learning objectives. We're going to describe first the decision making process, but then we're going to identify the relevant costs, which are important for our decision. Then we're going to identify for the different decisions, we're going to have a different cost. So we have to identify those costs under those decisions. One of the decisions to special price. The other one is make or buy. Should I do what I'm doing or should I buy outside? The next one is deciding, should I sell it as it is or should I process further? The other decision that managers have to do is, should I keep what I have as equipment or should I replace it with new equipment? The next one is the other one is to decide whether to eliminate or unprofitable segment. And the last one is to determine the sales mix when the company have a limited resources, how we should do that. Let's go first with the first one. First one is the decision-making process. How we're going to make a decisions. First, in order to make a decision, we have to have at least two alternatives. If we don't have alternatives, there's no decision to make. So we have the alternatives, but we're not always going to follow the process. So first we have to make a decision based on the scope and decision based on the urgency and importance. It's very interesting. I was talking to my wife the other day, and she told me, people that there's this kind of scale. Imagine yourself a square with the four angles, and put on the left top. Make it four squares, split it by four. The square, split it by four, and first category is most urgent and most needed. On the bottom will be, what was that? Urgent but not needed. The next one will be not urgent but needed. And the last one will be not urgent and not needed, something like that. And then she explained it. It sounds very interesting with the putting in mind this decision-making process, and you to start deciding which one should they focus first on the decision-making. Now, management must consider both. Obviously, as a manager, you have to consider both financial and non-financial information. Financial information will be a relevant cost, overall profitability, income, cash generating from the project. Non-financial will be everything else. You may accept project based on the financial and reject the same project based on non-financial. Why? Because it's just not a good project for the environment, or not good project for yourself, or not project to your family. There's so many reasons that we have to consider. Again, environmental and overall image of the company if you're on the management level. Which method, how are we going to make those decisions? Well, there's different approaches how we're going to make it. Again, if we have the full information, we can easily prepare income statement. But that's going to happen in rare cases. So calculating sales and all the costs and saying if we have income or we don't have income, that will be a very, very long process. And sometimes, again, we don't have that information. So what shall we do? Well, we can use the incremental analysis approach. What's the incremental analysis approach then? The process of identifying financial data that will change under alternative selection is called incremental analysis. So basically, we're not preparing the entire report. We're just chasing the changes. Currently is the situation. If we do this, what's going to change? The other thing that we'll do is we're going to chase cash. We're not chasing income. We're not chasing expenses. We're chasing cash. Cash coming in, cash coming out. Also, that incremental approach is also called differential analysis as well. Now, the data relevant to the decisions always will be different between alternatives. And that's where we're going to be. Okay, so once we make a decisions, we're going to have the original state, and then we're going to have differences between one another. We have to consider both revenue and cost, which are different from one to another, or only the revenue. on only the cost. The other thing that I want you to picture in your mind, the money in the company or in your pocket is going to come two ways. Actually, three ways, if you follow this. It's going to come from the sales and expenses. That's one way. The other way is only from sales. If you increase the sales only, keep the expenses the same, you're going to increase the income or the cash that you have. That's one way to increase the cash, to make it profitable for you. The other one is income stays the same, but you're reducing the expenses. You become more efficient the cost. That's another way you to generate cash. So again, the first way is income increase, expenses increase, but the sales increase, expenses increase, but the sales obviously is going to increase in the higher pattern than the expenses. Then you're going to generate income. The other way is cost stays the same, you're increasing only the sales, you're generating income. The last one is the keeping the revenue the same, reducing the cost, you're generating saving. Now, alternative, how are we going to compare those alternatives? So we have here, this is the example of incremental analysis. We're going to have alternative 1 and alternative 2. If we decide to go with the first alternative, our revenue will be 125, cost will be 100, net income will be 25. If we decide to go with the alternative, second alternative, our core revenue will be 110, cost will be 80,000, and the net income will be 30. So, if we decide with alternative B, then our revenue is going to decrease, right? The alternative B give us less revenue, or income is going to decrease to 15,000. But cost also is going to reduce with 20,000. So you're going to generate 5,000 income. The other way you can look at it, if I go with alternative B, that alternative is going to give me $15,000 less revenue. That's why the 15,000 is in bracket, because alternative B or second alternative give me $15,000 less revenue. But if I go alternative B, I'm gonna save 20,000 on cost. So my saving, if I go with the second alternative, is $5,000 less the revenue that I'm losing. So that will generate me $5,000 saving. Does that make sense?
Yes, Professor.
So do you understand why the second alternative is better than the first alternative? Because with the second alternative, you're gonna generate $15,000 less revenue, but you're gonna save $20,000 on cost, which is gonna give you $5,000 net income. What else we can do here? The incremental revenue, as you can see in the second alternative, $15,000 less, but the saving that you're generating is $20,000, which produce 5,000. So in that case, obviously the second alternative is better than the first alternative. Now, another thing that we have to talk about before we start making decision is what kind of costs we're gonna have. Here we're gonna have relevant cost. Relevant cost is the cost and the revenue which is different between one alternative and another alternative. The other relevant cost is the cost and revenue that will happen in the future. For example, if you decide to go to, let's say, to vacation with the airplane, one option is to go to Hawaii, the other option is to go to Mexico. In both cases, you have to go to the airport, where in both cases you have to get Uber, which is gonna cost you $50. Now the question is the $50 that you have to pay for the Uber to go to the airport relevant for your decision where to go, Mexico or Hawaii?
No,
No. Why not?
because whether you use Uber or you drive your car or you walk to the airport does not affect your going to the Mexico.
No, you should look a different way. If I have to go to Mexico, I have to pay $50 for Uber. If I have to go to Hawaii, I still have to pay $50 for the Uber.
Mhm.
Is the cost different? No.
No.
Then in that case, it's not considered. Only the cost and the revenue which are different between one alternative and another, that cost will be considered. Now, if you have an option now to go from your place to the school with the Uber, SkyTrain, and walk, then all the three alternatives are going to have a different cost. Then the cost for the transportation will be considered. When the cost for the transportation is exactly the same between the two, you not consider. The other cost that you have to consider is the opportunity cost. What's the opportunity cost? That's a very interesting perspective. The opportunity cost is the cost that you never have to pay. You don't have to pay it, but you have to consider it. Why? Because that's give you another, it put you in the reality, which reality might you might generate more cash. For example, right now you're sitting here and listening to this lecture, which in fact you don't have to. Why? Because you can watch the recordings later. What you're gonna do then? Well, what you're gonna do is if you have this opportunity cost that you can work right now and generate $20 per hour, that would be opportunity cost. So what should I do? Should I sit here for 2 hours and watch the lecture, or should I work and generate $40 income? $40 that you have opportunity to make it, that's your opportunity cost. Sunk cost is the cost that you never have to be considered when we're making decisions, because that's the cost that already happened. For example, again, let's go with the Hawaii and Mexico example. I'm deciding to go to Hawaii or Mexico, but I just bought my luggages. I spent $300 on the luggage. Is the cost for my luggage, my suitcases, is that cost relevant for my decision? Well, it's not. Why? Because it's already happened. That cost already happened. What I'm gonna go forward, that's a different story. This is the cost that I'm gonna consider. If I go forward, if I do something in the future, which choice should I make? For something that I already made my choice, that's not relevant anymore. That's a sunk cost. So for that reason, sunk cost is never considered to be relevant cost. Now the incremental analysis, on the incremental analysis, time value of the money, we're not going to consider time value of the money. And the qualitative factor, always going to be part of our decision. I remember now on the case, in some instances, there will be like you have to provide the quantitative and qualitative analysis, even in the marking grade, say that you have to provide quantitative and qualitative analysis. On those analysis, within the time constraint that you had for this case, you can do better, but considering the timing, considering the everything, the environment, you did a great job. Let's go with the first question today. When making decision, a general rule would be what?
D.
Question first, before we go to D. Did we ever talk up to this point about the fixed cost? Once I start the chapter, not before to introduce the chapter. Did I talk during the chapter that we started fixed cost?
Not yet.
Variable cost?
Yes.
Not really. The only thing that we talk here is relevant opportunity sunk cost, right? Do you see
Yeah.
here? Do you see here variable? No.
No.
Do you see here fixed? No. So the first two just eliminate it and then focus on the next one. So D is the correct answer. Yes, you're right. Let's do another one.
A.
A.
Hey,
Sunk cost.
sunk cost. Why? Because it's cost that already happened last year, for example, right? Not even this year. Okay, that is sunk cost. Now, the type of incremental analysis, we're gonna have 6, as you can see here. First is to accept order at a special price. Second is should I make it internally or should I buy it from outside? Either part, either finished product. Third one is to sell a product or process it further. Should I sell it as it is or should I make some adjustments and sell it in the new stage? Retain or replace equipment. Should I keep what I have or should I purchase new one? Next one is to eliminate or keep unprofitable business segment. And the last one is to allocate the limited resources. Let's go now. Special order. What's interesting with the special order? Special order is one-time offer. That offer never gonna happen again. Only one time. And come as a special price. So imagine this. I'm selling cups for 20 bucks. And there's a customer who comes and tell me, hey, can you make me one time and one time only 1,000 cups, but instead of selling it to me for $20 on the regular price, can you sell it to me at $15? That's a special order. Never gonna happen again. That's not gonna affect my business. The regular customer is not gonna find out about it. Now the question is, should I accept it or not? Now the decision criteria is this order for $15 from that person for 1,000 cups will be accepted only and only if my contribution margin is positive. Means that selling price $15 is more than my variable cost. As long as that $15 cover my variable cost, I'm okay. I should accept it. So now, key assumptions is the sales of the company other product lines would not be affected by these special orders. Also, the existing customer will not expect the same reduced selling price. The other thing that we have to make sure is the company not operating at full capacity. Because if I'm operating the full capacity, I won't be willing to sell that person for $15. Why? Because I'm also already selling it at 20. I don't have capacity to make a new one. to sell it at a lesser price. For that reason, I mean, I cannot make that $15. That's not on the table. So let's see now the example. What I can do is I can copy this one, the entire slides. And you already know me that I like Excel. So I'm gonna move this to Excel and we can work on the Excel spreadsheet, if that's okay with you. So the people who are not comfortable with Excel, how do you feel now? Do you feel better, start getting better?
Yes, Professor.
That's good. So I have the information, now I can flip it everything to the Excel spreadsheet. Of course, I'm gonna post you after that those Excel spreadsheets. Now, can you see my screen?
Yes.
Okay. What we have to do is to see where we are and what's going to happen. Now, this customer offered us to buy a special order of 2,000 blenders at $11 per unit. So if we sell it, what we're going to get? Sales will be
22,000.
right. Let me make this a little bit bigger so you guys can see it. Sales will be 2,000 units, 2,000, 1, 2, 3, and the sales price is price per unit 11,000. So my total sales will be this one time 11,000, $11, sorry, 22,000. That's my sales price. Now, let's see what would be my cost. First, let's see where we are. This order would not going to affect the normal sales, and we have sufficient capacity. What that means, our capacity at this moment is 10,000 units. We can produce 10,000 units with our capacity. Currently, we are at 80%. What that means? Current production is our current production is 100,000, not 10,000 units, 100,000 units. That's even worse. So our current production is 80,000 units. The question is, do we have to produce capacity to produce 2,000 more?
Yes.
Yes, yes.
We do have the capacity, right? Now, the current fixed manufacturing cost is 40,000.
400,000.
400,000, yeah, 400,000. That's the current fixed manufacturing cost. Now, if I produce one additional unit, how this going to affect the current manufacturing cost, total manufacturing cost?
No effect.
No effect. Why? Because between 0 and 100 units, my fixed manufacturing cost will be $400,000. Currently, I'm producing 80. So if I increase with 2,000, that's not going to affect my fixed cost. Is that clear for everybody?
Yes, Professor.
Okay. So my variable cost, on the other hand, per unit is $8, right? My normal selling price is $20. So on my normal selling price, if I sell it for 20, my contribution margin is $12, correct? In the normal operating activity, normal sales, everything is normal. So in that case, I'm generating normal contribution margin 12. Now this guy, he asked me to sell him for $11, correct?
Yes.
My variable cost is $8. How much is my contribution margin in this case? Is it positive?
Yes.
Yes.
Yes. So that's one thing. The other thing is those additional 2,000 units going to affect my total fixed cost, which is 400,000 units, $400,000. We already say
No.
no. No. So in this point, should I accept this order?
Yes.
Yes. Because I'm clearly going to make 3,000 per unit, correct? That's out of question. I'm going to make $3 per unit. And since I'm going to have to produce 2,000 units, how much will be my my profit here?
6,000.
Sorry? I'm generating $3 contribution margin per unit. And since this person asked me to make like 2,000 units, how much will be my profit?
6,000.
6,000. So now, what we're gonna do here is something that will be very similar to the assignment questions that you're gonna see in Brightspace or in the Wiley thing. I want to stay with Wiley so you're gonna get it. This is one way to approach the case. The other one is the way Wiley approach it. We're gonna have this revenue, we're gonna have the fixed cost. So they're saying this. We have decisions, two decisions to reject or to accept. So that will be a reject like this, and then to accept. What should I do? If I reject it, if I say no to this guy, how much will be my revenue? 0. How much will be my variable cost? 0, since I'm not doing it, I'm nothing. How much will be my my contribution margin?
6,000.
No. I'm rejecting it.
0.
0. 0 minus 0 give you 0, right?
Yeah.
Now, if I accept it, what's gonna happen? Well, I'm gonna generate $11 from 2,000 units. So I'm gonna generate $22,000. But I have to pay cost. And my cost will be the same 22,000 units times $8 per unit,
16,000.
right? That will be 16,000 negative. So what that's gonna give me?
6,000.
6,000.
6,000.
Oops, that's not the one. Equal to this one plus that one. That will be 6,000 contribution margin. So should I go for it?
Yes.
Absolutely go for it. So now the question is, again, what will be the effect on the net income? So net and the effect income
0.
is
6,000.
right.
That's 6,000 more.
This one will be increasing. Revenue is gonna go. Then the next one will be the expense variable cost gonna go, and that will be trigger the $6,000 increase in my contribution margin. That's gonna keep it directly on the operating income, net income. That's how Wiley wants you to do the questions, right? So they want to show you reject and accept, and what's the difference between one and the other. Make sense?
Yes. Yes.
That's all you have to do. Okay. So let's go back to slides and keep going with the next project. So again, don't forget this. This is only one side of the coin. we always have to do that qualitative analysis. At this point, yes, accept the order, $6,000 coming to your pocket, but we still have to do the qualitative analysis. Let's see this one. So in the incremental analysis, which are the 6 decisions? Those are the 6 decisions, except for a special make up, buy, sell product, retain, replace, eliminate, and allocate. So the question asks.
It's all of the above.
All of the above, right?
Yes.
So let's do this question now. I'm gonna copy it, move again to the, oh no, I need this information as well, right? Let's get everything, one after another. I'm gonna move to the Excel. That will be question 1. PowerPoints. And get this one too, and I'm gonna flip you now to the okay, that's even better here in this question. That's a way better. Okay. Here comes the Excel. Share my screen. Now we can see the question, right?
Yeah.
Okay, let's go working on this question. You have our information about units, cost per unit. Now this capacity, first, do they have the capacity? They produce and sell $200,000 per month. Cost at this level provided on the table below. So we have the cost. We have the prime cost. Prime cost is what?
Direct material and direct labor.
Perfect. So prime cost, you can put it for yourself, direct material plus direct labor. That's our prime cost. Then we have the variable manufacturer cost 0.75, and then we have variable marketing cost of 0.25 cents. Now the fixed cost are fixed cost, right? So currently our capacity is $200,000. Currently we're selling $175,000 per month at $1.55 per unit. This company was contacted by CC. This poor company has contacted CC about purchasing a 15,000. Now we have to find 15,000 units. That will be, let me make some adjustments here. That will be more like that. 15,000 units. Chasing 15,000 units at units. And they asking for sales price. A sales price to be 105. We need those zeros. 105. Okay. We have the sales price, we have the units. The question is, do we have the capacity?
Yes.
Yes. We have 25,000 capacity, so 15,000 shouldn't be a problem. So since we have the capacity, how my fixed cost gonna be affected?
Not affected.
Not affected at all. So which cost I should consider?
What do you
Only the variable cost. Those are my variable costs. So now let's see which one of those costs I should consider. Current sales would not be affected by the special order, and the variable marketing cost will not be incurred on the special order. So which one is not going to happen?
have?
That one, right? So this one, it's not going to happen. Let me highlight it different color, like this one's not going. This not happening. So which are the costs that you should consider? Only those two, right? So how much? What will be the change in the income if the order is accepted? So how much will be my variable cost now? Variable costs are going to have only two components. Which are those components? That will be equal to these guys, and no, the prime cost is the first, these guys, and then I have these guys. This is my only cost that I have to consider. Correct?
Yes.
So once I consider those costs, how much will be my contribution margin? Equal to this one minus this one and minus that one, right? Let's see how much exactly is. That's how much is my contribution margin. How many units I'm going to purchase?
15,000.
So units is 15,000. So how much will be my total effect? Net income increase. How much will be that?
9,375.
9,375. Do we have that as an answer? Let's see. What's the available options? Let's go back to the slides and see where we are. Do we have this as an answer?
Yes, number 8.
Yes. So what will be the logical answer?
A.
A. Increase with 9,375. Okay, awesome. Let's move to the next one. Next one decision that we have to make today is should I make it or should I buy it? In other words, should I outsource? Obviously, all the management consider this. Should I make it in-house or should I buy it from outside? What's the decision criteria? Based on what? We'll outsource. Are we gonna make it? Are we gonna order it? Only and only if the total cost saving is positive. So basically, whatever we save on the costs is more than we have to pay. Or, in other words, we're gonna compare how much we have to pay, how much we have to cost us to make it internally. If the cost that we make it internally is more than buying from outside, we're gonna save on the costs. So that means go for it, go outside. Again, you have to do the qualitative analysis. Once you make it the outside, you have to be careful with the qualitative analysis, which will include quality of the product, environmental issue, community impact, employee impact on the company. Which is the advantages if we decide to go outside, outsource. We're gonna free capacity for something else. Or we can shift the product risk to the supplier, which is the disadvantages. We may lose the ability to control the quality. The next one is the difficult to bring the product back if it's needed. And we have to make sure that there's the person who's making actually has experience and materials to do it. Let's see now how we're gonna do. What's the question here? This company outsourcing the decision to buy parts or services rather than making them. Byron happened the following cost: 25 switches. We have direct material, they have direct labor, they have variable manufacturing overhead, fixed manufacturing overhead, total manufacturing cost. Total cost per unit cost them $9. This company magically come up and say, hey, you know what? I can produce those switches. I can sell it to you for $8 per switch. Would you accept the offer or not? So let me copy this entire sheet and let's work on the numbers on the Excel spreadsheet before we make the conclusion. That will be question 2 on PowerPoints. This is where we are. We have to decide, shall we outsource it or shall I make it internally? Just give me a second to make some changes here. And I'm gonna put you. So I have to do some manual typing here. Just give me a second. We're gonna go together this part of the manual typing order. We to decide what shall we do. Should I make it or should I do it? Should I give it purchase it from outside? Stop sharing this and open the Excel spreadsheet. Now you guys can see my question, right? So we have direct material, we have direct labor, we have the variable manufacturing overhead, we have the fixed manufacturing overhead. Let's make those bigger. Okay, and the direct material is 50,000. Direct labor is 75,000. Variable manufacturing 40,000. And the fixed manufacturing is 60,000. Now, how many units I'm producing? What's my current production? Can you guys see my screen?
Yes.
25,000.
25,000 switches. 25,000 switches I'm producing right now. So what's my cost per unit? Direct material per unit. How much will be that? $2, right?
Yeah.
So what will be my direct labor cost? $3 and $1.60. Fixed manufacturing overhead. Do I have to convert it per unit?
No.
No. Okay. So how much is my total cost? Variable cost only. At this point, my variable cost is 6.60 cents, right? Now let's see now. I can purchase it for $8. So what will be that? Let me see how exactly the Wiley doing this. Okay, and they staying with those figures, the one that we have. And what else we have? Fixed overhead. Gonna try to do exactly the same copy because again, I don't want to confuse you with that. And then we're gonna have a purchase price. Okay. So eliminates, so this order will eliminate all the variable cost and 10,000 of the fixed cost. However, 50,000 of the fixed cost will gonna stay. Make sense?
This is like the second scenario.
Sorry?
Like the second scenario. Those,
So basically, if we decide to eliminate, we're gonna start. If we decide to stop it, we can save how much of the 60,000? Can we save the entire 60,000?
No. Only
No. How much are we gonna
10,000.
save? 10,000. So 10,000 divided by 25,000 units, how much we can save? Can you see it? 40 cents, right? So how much cost us actually to produce it?
There. It's purple.
Actual cost to produce it is $7. Somebody offer us we to buy from him for $8. Should I buy it? Hmm? No. How much I'm gonna lose if I buy?
$1 each.
$1 per unit. How many units I'm doing?
That's 200. So that's
25,000. So
$200.
if I decide to buy it from this person, I'm gonna lose how much? $25,000. If you have $25,000 that you don't know what to do with them, go and buy it from this person. So how much cost me to make it? Let's go. That will be make. If I make it, that's how much gonna cost. Correct? We already know that. 225 total cost. Now, if I buy it, do I have to pay direct material? If I
No.
start buying, no. Direct material will be zero. Direct labor,
Yes.
Zero.
no. I'm not. I'm buying it, right?
Okay.
Once I buy it, no direct labor. Variable overhead, still zero. Fixed overhead. How much I have to pay if I have to buy it?
Okay.
40,000 remains of the fixed.
So no 40,000 or 50,000 remains.
50,000.
40,
50,000 remains, right? Because the total cost is 60. 10,
okay.
yes, 50,000
Yeah.
remains, right? 50,000 remains. And plus I have to pay,
Yeah.
I pay the purchase price, right? How much I have to pay for purchase price? Now I have to pay 25,000
$8.
units times $8. So I have to pay another $200,000. That's how much the guy asked me, $200,000. So how much is gonna cost me total cost?
250.
250. Right? What's the difference now?
25.
So effect on income. So what we have to do here, effect on the income will be, okay, that will be equal to this one plus this one. Is that how it's gonna be? Or this one minus that one? Yes, this one minus that one. It's gonna be make minus buy, right? If I, that will be my effect on the income. So if I decide to buy it, what's gonna happen? My income is gonna go down with $25,000, right? What's gonna happen if I buy it? I'm gonna save $50,000. That will be my saving. $75,000 will be my saving. $40,000 I'm gonna save. 10,000, only 10,000 for the fixed manufacturing overhead I can save. But I have to pay $200,000 for these guys to make it for me. So I'm gonna lose $25,000. Make sense? So this is the way that you have to do it on the assignments. That's why I'm going this way, because this is the way you have to do it on your assignments. Again, I'm gonna post it those one, that those will be available for you. So you don't have to worry about this. Let's move to the next question, which will be the from the slides. So now the opportunity cost, that will be potential benefit that may be obtained by following the alternative course of action. For example, now assume if we decide to purchase it, we're gonna lose 25,000. But with the facility that we have, we can generate $38,000 additional income. Now, if the opportunity cost is 38,000 income, should I make it or should I buy it now? Make sense? At this point, I'm losing 25. But if I purchase it from these guys and lose 25, with the capacity that I'm freeing, I can produce a new product which is gonna generate $38,000 contribution margin. Should I make it? Should I buy it now?
Buy.
Buy it, right? How much I'm gonna make?
13.
$13,000. Make sense? So now the total, if I make it, that my total cost is 225. No questions about it. But if I keep making it, I'm gonna lose the opportunity to generate $38,000. If I buy it, my total cost will be only 250. So in that case, if I do that, yes, from buying it, I'm gonna lose 25,000, but because I'm using now the capacity to generate 38, I'm gonna generate $13,000 income. Does that make sense? Yes or no?
Yes.
Loading.
Sorry?
Sir, can you repeat this part?
Can you repeat the question again? Sorry, I cannot hear it.
If you can repeat this last part.
Okay, I'm gonna continue. If we have to clear it, let's clear it in class, okay? So now on the making or buy decision, relevant costs are, which are the relevant costs of making the buy decision?
All of the above. D.
All of the above, yes. We have to consider all of them. Now let's do one thing ourselves. See what we're gonna have here. This is the first part of the question. Again, I'm gonna flip it to the Excel spreadsheet. And we can work on those. Okay, this is our question now. Can you guys see it?
Yes.
Let's go one after another. This manufactures parts used for several of the engine monthly per unit production cost of for 1,000 units are provided on the table below. It's estimated that 10% of the fixed overhead cost will be no longer be incurred if the company buy this one from the outside supplier. The cost to purchase from the supplier is 85 per unit. If this company purchase 1,000 parts, the outside supplier per month, the monthly net income will what's going to happen with the monthly income? It's going to increase, decrease, or what exactly is going to happen? So if we still making it, what's going to happen? We're going to have all those things, right? Let's do the same thing that we did on the previous chart. If we're making it, that's what's going to happen. But times 1,000, correct? Because we purchasing 1,000 units. You guys with me?
Yes, Professor.
So how much will be my cost? Will be 40 times 1,000. 40,000. My total cost will be that much. $100,000. 1,000 units, $100 per unit. That's what's gonna. That's if I make it. What if I buy it? Let's buy it now. What's gonna happen if I buy it? I'm buying 1,000 units, correct?
Yes.
But these guys want me to pay 85, right?
Yeah.
So insert here purchase price, purchase. So if I buy it, how much will be my direct material?
Zero.
Zero. How much will be my direct labor?
0,
How much will be my variable overhead cost?
0,
How much will be my fixed overhead cost?
10%,
So estimated that 10% of the fix will no longer be incurred if the company buy from the outsider. How much is gonna stay with me? 10%,
90,
90%. So how much will be the cost that I cannot save?
18,000.
18,000 times 0.9. 18,000 is gonna stay with me. Plus I have to pay 1,000 times 85, right? So now
Yes.
how much will be my total cost? Can you see it?
Wow. Yes.
So what will be my effect on the income?
It's better to buy.
On income. So once I get this one, what was that? Equal to this one minus that one. If I do this calculation, I can easily see that what's gonna happen?
Decrease by 3 when buying.
With $3,000, I'm gonna lose $3,000. Make sense?
Yes.
Okay. Let's go to the slides. So our income in this case gonna decrease by $3,000. Now the next one. Should I sell it or should I process further? Now, once the decision, that's when we have a single product which we're selling at some point. And then we have to decide, should I do some modification in the product, which is gonna give me opportunity to sell it on the higher price, or should I keep it the way it is? For example, imagine this: we selling milk. We producing and selling milk at $4 per liter. Now, we're coming to the point that, okay, I can still sell it at $4, right, as a milk, or I can convert it to cheese. If I convert it to cheese, I can sell it for $10, but it's gonna cost me $5 to make it. Should I convert it to cheese? So let's think about it. If I convert it to cheese, I can sell it for $10. Currently, I'm selling it for $4. How much more incremental revenue I'm gonna generate? How much additional revenue I can generate if I convert it to cheese?
Right?
So again, listen, I'm selling it currently at $4 per liter. If I convert it to cheese, I can sell it for $10. How much additional revenue I'm generating?
$6.
$6. $6. But it's gonna cost me $5 to convert milk to cheese.
So
Am
you're
I
going
make, so am
yeah.
I should I convert it to cheese or not?
No.
I think you can convert because you still earn like an extra dollar after converting.
Of course I'm still making extra dollars. Then go for it. What do you want? Do you want to make $4 or do you want to make $5? Make sense?
Yeah.
5. Then go for it. Do you understand this logic? As long as the additional incremental revenue is more than additional cost, go for it. So any cost which happen up to the point of we decide to make a decision, should I go for it or should I not go for it, is irrelevant. There are two scenarios. This is scenario first, if you're doing the single product, the company produces only one product that can be sold or processed further. And the other one is if you're doing multiple product. The company produces multiple products simultaneously from the single raw material, which is referred to as a joint products. So for example, I'm producing milk, and from milk I can get cheese, yogurt, cream, 50 half, half and half. I can get I don't know what else I can get. Butter, so many things. The question is, should I go for it? Should I not? Again, we're gonna chase the incremental or additional revenue that we're getting versus the additional cost to process it to the new product. So in that case, some of the products can be processed further. Some of the product we may decide, no, that's not profitable. Let's see the example. This company manufactures a single product, which is a table, which unfinished table is sold at $50 per table. They currently has unused capacity that could be used to process each table further and sell it as a finished table for $60. How much is the additional revenue that you're gonna generate? Can you see it? Currently, I can sell it for 50. If I process it further, I'm gonna generate 60. How much additional I'm gonna generate? Can you guys see the screen?
Yes.
So again, I can sell it as it is right now, or I can process it further in my warehouse and after that sell it for 60. How much additional I'm gonna generate? Sorry?
$10.
$10. $10.
Yeah.
Now what we have to do is, if I have to process it further, how much gonna cost me? I can see that I can sell it for $10 more, but now how much will be my cost to move it to that? So let's see how much is the cost. Relevant to finish the table is direct material. I have to put $2. I have to put labor $4, and I'm gonna have the variable manufacturing overhead $2.40. What should I do?
I think you should still go ahead because
How
you
much is the additional cost?
6.40.
8.4.
8.4.
8.4, yeah.
8.4. How, but that's the cost. How much is the I'm generating? $10.
10.
So I'm still making 1.6, right?
Okay. Yeah.
So let's see if that's the true. So if I sell it for 50, my direct material will be 5, 10, 6, 4. That's it. If I process it further, I have to add, I'm gonna generate those $10 extra, but I have to add $2 to direct material, $4 to direct labor, and $2.40 to manufacturing overhead, which is gonna give me 1.6. Are we producing it? Yes, absolutely.
Yes.
We're gonna generate more. Make sense? Okay, let's see this. How about the multiple product? If we have a multiple product, then we're gonna follow the same structure. We're only gonna produce those one who generating more revenue than the currently we have over the additional cost that takes us to process it further. Now let's go with the milk. This company selling raw milk through the common process of the two main products, cream and skim milk. The joint costs incurred the common process are not relevant for this decision. So whatever the cost is until we decide to split it, the cream and skim, not relevant. So total joint costs are 14,000. We already said that's irrelevant. Forget about it. Allocated to the main product, 9,000, 5,000. Additional processing cost, now additional from here, in order to produce a cheese, additional processing cost, cottage cheese, 10,000, condensed milk, 8,000. So the first decision, well, they don't give us any more information, really. That's all. Additional process. They only give us the additional processing cost. There's nothing on the revenue side. Let's see what they have. The first decision: sales per day is 19,000. Process further 27,000. Additional will be 8,000 for the cottage cheese. Oh, this is the incremental. So if we sell it as it is, we're gonna generate 19,000. If we move it to the cottage cheese, we're gonna sell it for 27. So we can generate 8,000 more, but cost us 10,000 to produce it. Shall I go for it? No. Next one. That will be the condensed milk. No, that's still for the cottage cheese. Let's see the condensed milk. Condensed milk, I can sell it as it is, as skim milk. I can sell it as it is as a skim milk and generate 11,000. Or I can process it and make a condensed milk for 26,000. I'm going to generate additional 15,000, but it's going to cost me $8,000 to make it. Should I make it?
Yes.
Yes, no questions about it. Why? Because it generates $7,000 more.
Yeah.
Make sense?
Yeah.
Yes.
Okay, let's see this question. Now, the decision rule to sell or process further is to process further as long as the incremental revenue from the processing is more than what?
Okay.
Absolutely.
Okay.
Incremental processing cost. As long as incremental revenue is more than incremental processing cost, go for it. Don't even think about it. Just go. Which of the following is not qualitative factor?
Cost of labor.
Cost of labor. Everything else is qualitative. What's the cost of labor? What kind of factor?
Quantitative.
Thank you. Let's do this. This manufacture alpha and beta from the joint process. Cost is eta. 5,000 kilogram of alpha can be sold and split off for $20 per kilogram, or processed further at additional cost of 20,000 and then sold for 25 per kilogram. 10,000 kilogram of beta can be sold as a split off point for $15 per kilogram, or processed further at additional cost 20,000 and sold at $16 per kilogram. If the venture decide to process alpha beyond the split point, what's going to happen? So, what the question asks? The question asks about, the question asks about alpha, correct? Can you see it?
Okay. That's part of
Right? Is beta relevant for our decision? Do you have to do any calculation about beta?
No.
No. So, all this sentence, I can easily delete it. It's not relevant for my question. I don't care about that information. So, where I'm focusing on the 5,000 kilograms of alpha. 5,000 kilogram can be split off for 20 or processed further for 25. How much I'm going to generate per kilogram?
Is it 5,000?
How much more I'm going to generate per kilogram?
5,000?
No, listen, 5,000 kilograms, right? Let's stay per door. So yes, 5,000, $5 per kilogram, correct?
25,000.
So 25,000. So let's stay first with the per unit, per kilogram. Okay. Let's move everything to kilogram. So currently I'm selling for $20 per kilogram. If I go further, I'm going to sell it for $25 per kilogram. How much per kilogram am I going to generate? More. $5 per kilogram. Now let's see how much it's going to cost me per kilogram to get those $5. It's going to cost me in total 20,000. How much I'm going to generate from 5,000 extra? Remember those $5 times 5,000 kilograms, how much I'm going to generate?
25.
25 minus 20,
5.
5.
increase or decrease?
Increase.
Decrease.
Increase.
Increase.
So again, this is the selling price, $20 versus 25. Which one is better for me, to sell it for 20 or 25?
25.
How much more I'm going to generate? $5 per kilogram, right?
Yes.
1,000.
5 times 5,000, how much I'm going to generate? 25,000, correct?
Yes.
Yeah.
But it's going to cost me 20,000. Am I making money?
An increase of 5,000.
Increase of 5,000. Make sense?
Yes.
Okay. Let's see if that's the, yeah, that's the one. 5,000 increase. Okay. So now, shall we keep it what we have or replace it with a new one? This is another decision that you have to make as a managers. Now, decision criteria. You're gonna replace this asset if the new asset increases the net income. Again, we forget about the time value of the money. Capital cost allocation, income taxes, those are not part of this. Book value. What will be the book value? Book value will be the original cost of the asset. Sunk cost, remember, never relevant. Then we're going to have something new, salvage value. Salvage value is the estimated amount that we can get when we sell the assets at the end of the useful life. And useful life is the how long the company can expect to generate revenue from the asset. Useful life is not the life of the asset. It's just how much the company is going to use the asset to generate revenue. Now let's see this. First, we're going to have this company which consider replacing one of their machine with the new machine. If the new machine is purchased, let me flip this one here. If the machine is purchased, variable cost will decrease from 160 to 125. So we're going to generate saving in the cost. The other information is, this is our other information. I'm going to flip it to the Excel spreadsheet and we can start working with that one. Copy this one. Okay, and I'm ready to share my screen. Okay, so the other information is the book value, cost of the new machine, remaining useful life, and salvage value for the old machine. Now the question is what we have to consider, what we don't have to consider. So first, we're gonna get this variable cost that we currently have, and that variable cost is how much? That variable cost is 160,000, correct?
Mhm.
We have that 150,000, 60,000 variable cost. But this is per year, correct?
Yes.
Now, this is per year. Per year. Now let's do the whole calculation. Now, if we decide to keep it, the machine, what's going to happen? And if we decide to get rid of it, keep the old one or replace. What's going to happen if we decide to replace it? What's going to happen? Let's first with the variable cost. If we decide to keep it, that variable cost is going to stay with us, correct?
Yes.
How many years? For 4 years, right?
Yes.
That will be years. 4. Let's change this formatting. 160. 640,000, correct?
Mhm.
If I get it. If I replace it, how much will be the cost?
Mm.
125 per year, right?
That's 500,000.
Right? So if I decide to replace it, my new cost will be 125 time
500.
for 4 years. My new cost will be 500,000. That's the first thing. Second thing, let's see now. How much will be my new machine? New machine. My new machine is going to cost me 120,000. Correct?
Yes.
What I can get, but that will be 120,000. Yes, 100,000. What I can get? I can get the salvage value of the old machine. If I sell the old machine, I can get it as a salvage value. How much I'm gonna get? 5,000. Make sense?
Yes.
Yes.
So that will be my variable cost, that will be the new machine, and that will be the salvage value. Okay. But the salvage value is gonna reduce my cost, right? That will reduce my cost. So the total cost will be, if I have to do the total cost, let's put it this way. My total cost here is 640,000. Here my total cost will be 650. What should I do? Keep it or replace it?
Replace.
Replace it. How much I'm gonna save?
5,000. 25,000.
25,000 income. Let's see what will be the income change here. It's gonna be this one minus this one, right?
Yeah.
40. Why this doesn't format this? Next one will be boom. So how much I'm gonna generate? I'm generate $25,000. I'm gonna save 140,000 on the variable cost. I have to pay the new machine, but I'm gonna generate 5,000 from the selling the old machine. So in total, I'm gonna get $25,000 positive change in my income. Make sense?
Yeah.
Awesome. Let's move to the slides. Okay, that's our slides. So as you can see, $25,000 we generated. Now, what's the salvage value of the old? What is the salvage value of the old we consider to be?
Opportunity cost.
Opportunity cost, yes. That will be, no, actually that will be relevant cost. No, opportunity cost, again, once you think about the opportunity cost, is the cost that you don't have to pay. The salvage value is not a cost at all. More like a relevant cost. Yeah, more like a relevant cost. Even though the salvage value is the money that you're gonna get. So I don't think it's actually cost. It's more like a relevant revenue that we have to generate. Let's go with eliminating the unprofitable product or segments. So the management may have to decide to discontinue one product or segment or a customer. So what's the decision criteria? We're gonna eliminate this product or segment or customer only and only if that improves the overall profitability of the company. So before we do that, we have to think about it, which cost can be avoided and which cost can be not avoided. Variable cost definitely can be avoided. Then we go into the fixed cost. How much of the fixed cost can we avoid and how much of the fixed cost will stay with the company. So the avoidable fixed cost is the one that no longer happen if we eliminate the product. Unavoidable cost is the one that's gonna stay with the company, gonna be transferred to the different department inside the company. So we have to consider the effect of the relevant product. We have to consider the fixed cost, which is allocated to the unprofitable line or segment, or we have to eliminate those one in order to make the right decision. Because if we eliminate the division based on the fixed cost, which is incorrectly allocated to that division, we can easily destroy the company. That may lead to the net income actually to decrease rather than increase. Again, the decision criteria is we're going to keep the product unless the saving or eliminating cost are more than the contribution margin that we're going to lose. So this case, currently, we're going to manufacture those three products. Actual fixed cost will not change if this unprofitable product drops. Shall we drop the champs? So again, so what that means is we have those pro, master, we have this pro, master, and champ. Our total fixed cost is 160. If we eliminate this champ, which losing currently $20,000, those 160 is not gonna change. The question is, shall we eliminate the champ? Well,
Yes.
so we have to see fixed cost. If we eliminate the champ, can I save the $30,000 fixed cost?
No.
No. But I'm gonna lose the $10,000 contribution margin.
Yes.
So what's gonna happen? I'm gonna lose $20,000. So should I go for it? Should I eliminate it?
Yes.
You
When
don't
I
know
ha-
what
so when I have the champ,
you're
my
not
net
good.
income is 220,000.
That's why they charge am with the laptop.
Can you see
Thank
this? Can you guys see this? If I have it, I'm making $220,000. If I get rid of it, I'm making 210.
Mhm.
Should I eliminate it? Again, if I have the champ,
Mhm.
I'm making 220,000.
Mm.
If I eliminate it, I'm making 210. Just a second.
No.
Just okay. So again, if we keep it, champ, with champ, we're making 220,000. If we decide to get rid of it, we're gonna lose 10,000. Should I get rid of it?
No.
No. Make sense?
Yes.
Those $30,000 that you having seen here as a fixed cost, you're not gonna save it, but you're gonna lose $10,000 contribution margin. That contribution margin directly is gonna hit you on the operating income, which happened directly. So be careful. If we're not saving on the fixed cost, we're gonna lose entire contribution margin. If the company says that, hey, you from the 30,000 fixed cost, you can save 20, then it's a different story. So that will be the decision criteria here. If we eliminate it, we're gonna lose the contribution margin, 10,000, but there's no savings here. we cannot save anything on the fixed cost. For that reason, don't eliminate it.
No.
Now, how should the portion of the fixed cost that are unavoidable be handled when deciding whether to eliminate the unprofitable segment?
I think this is A.
So, we're talking about the portion of the fixed costs that are unavoidable to be handled,
B.
right? Is this fixed cost unavoidable? Yes. Is it avoidable? No. Is it unavoidable? Yes, it's unavoidable. Why? Because we cannot avoid anything. Make sense? So in that case, how should we treat the unavoidable cost? Not avoidable, unavoidable. It should be subtracted from the contribution margin. Is it subtracted? No.
No.
So one is A. Gone. They should be allocated to the other segment. Well, they're allocated, but that's not to solve our problems. Fixed costs are never relevant. They are relevant. So what we should do should not be considered as they're not relevant. Unavoidable costs, we're not considering those costs because they're not relevant. Let's see this one. This company manufactures and sells the two items. Those are the two items, A and B. The company considered dropping the product B. I'm gonna flip this. I think I can do it in Excel faster. Let's do it quick 5 PowerPoints. So the company considering dropping B because not making enough money. They want more money. So the question is, shall we do it? Shall we eliminate it or shall we keep it? That's where we are. Before we do that, what we have to consider, is there any fixed cost that we can avoid? Obviously, we're gonna lose the contribution margin, but is there any fixed cost that we can avoid? So here, you can see me, right? So you can see the question. This company manufactures and sells two items, product A and product B. The company considered dropping product B. It's expected that the sales of product A will increase with 30% as a result. If the product B is dropped, fixed cost of 2,000 will be avoided. And we have this income statement. Let's see what the question is. What the impact if the dropping the product B will have on the monthly operating income? That's where we are. That's what we want to try to find out. First, if we drop it, what's going to happen? Let's pretend we drop it. What's going to happen with the sales? Sales, which product is going to stay? We're dropping this division, this product, we get rid of it. It's gone.
Product A sales increase.
So the sales going to increase with 30%. So what will be that? 10 times time 1.3, right? My sales going to be $13,000. Okay, fine. That's fine, right? Increase in sales. What's going to happen with the cost? How much will be my variable cost? So sales product will be increased with 30%. My direct labor and material also is going to increase with 30%, correct?
Mhm. No.
Are they?
No.
Again, sales, increasing product A, the
Oui.
sales product A will increase with 30%.
Mhm.
Okay, let's see. Okay, let's pretend the direct material stays the same.
Yeah. This cost is reduced.
How much will be my contribution margin? Minus this one and minus that one.
7,
Fixed cost. What's going to happen with the fixed cost?
It dropped by 2,000.
So would drop with the 2,000. Currently 6,000. We drop by 2,000 is going to be 4,000, correct?
4,000. Yes.
So how much will be my operating income?
4,005.
4,500. Where we are currently?
4,003.
300. What's going to happen with the income?
Increase by 200.
200.
Increased by the 200, right? But
Yeah.
that's when we consider only change in the sales price, correct? This is considering sales of the sales price. But what we know about the sales, we know that when the sales increase, are you with me, guys?
Yes.
If the sales increase, the variable cost also increases, correct?
Yes.
We cannot consider only change in the sales because it doesn't say here the selling price goes up. It says the sales goes up. And once the sales goes up, our variable cost also is going to go up with how much? With exactly the same. Make sense?
Yes.
So this one time 1.3. If that happen, that will be our operating income. What's happened with the operating income? This one minus that one. Increase or decrease? This is
Decrease
decrease with how much?
1,050.
1,500. So which one will be the correct assumption? Because here we have two. We have to fight between two. This one and this one. No, that will be equal to this one minus this one. Here we have decrease, and here we have increase, here we have decrease. Which one is the correct? Is it gonna increase with 200 or is it gonna decrease with 1,500? 1,150.
To decrease with 1,150.
Again, that will be the correct one. Why? Because once sales increase, we have to assume that's gonna affect not only the sales price, but also direct material. Total sales will be affected as well as the variable cost. Make sense?
Yes.
Okay, don't forget that one. I'm gonna test you on this question on the quiz next week. So, limited resources. Let's finish with those limited resources and let's finish this chapter.
But sir, you said this chapter is not going to come out in the quiz next
Oh
week.
yes, but I'm gonna not next week. The last quiz on the last quiz, I'm gonna give you this question, or
Okay.
not this question like
Okay.
this,
Okay.
just to see if you understand the logic that when we increase the sales, that's gonna affect not only the total sales, but it's gonna affect the direct material, direct labor, or variable cost. Because here, as you can see, the question clearly says expected sales of product A will increase with 30% as a result. sales of product, it's not the selling price. Right? So let's go with this allocated limited resources. All the input resources are limited. And it can be floor of the space or the raw material or direct labor and anything. So in that case, we have to decide which product we can sell to maximize our net income. Now the decision criteria is we selecting the product or product combination that only maximize the net income. How can we do that? We're gonna get the products. For example, we're producing two different phone cases, standard and deluxe. We have unlimited resources, 3,600 machine hours per month. Contribution margin and resource usage are as follows. So we have this deluxe. Gonna try to copy it in the Excel spreadsheet and see if that's gonna flip easy. Yes. And at some point I'm gonna move to the Excel. Let's keep going with the PowerPoints. And once it comes to the Excel, I'm gonna flip to the Excel so you can see it on Excel calculation. So we have limited resources, 3,600 hours. And which of the product should be focused to maximize our net income? The decision rule here is we're gonna go with the product what generates the maximum contribution margin within the limited resource. For that reason, what we have to do is for something very simple. First, I have to flip to the Excel spreadsheet, and second, we're gonna go with the assumptions. So we have 3,600 machine hours. We would like to produce more, but we don't have it. So for that reason, we're gonna find out which one is the one that producing the high contribution margin within the machine hour. Make sense?
Mhm.
So the question is, for one machine hours, how much contribution margin I can generate from the first product? Or in the other case, let's go with this. For one machine hour, how many products are the first one I can generate? For 1 hour, how many units I can generate on the deluxe?
Three. Is it
1 point?
3 points?
1.2, right?
No.
1 machine hours. And for 1 machine hour, how many units of the standard cases I can produce?
Wait.
No, that will be 2.2. 2.2 here here will be 5, right?
Mhm.
Make sense?
Mm. I don't know how you arrived at this 2.2 and 5.
So I have 1 hour, right? I have 1 hour to utilize. And so the calculation will be x time 0.2 should be equal to 0.2 should be equal to 1 hour. How much is x? Make sense?
Yes.
The other one is x times 0.4 should be equal to 1 hour. Now the question is, how much is x? That will be equal 1 hour divided by 0.2. 0.2 here is going to give you 5. And here will be equal to 1 divided by 0.4 is going to give you 1.5 units. 2.5 units. 2.5 units, right?
Yes.
So how much is the contribution margin per unit? For 1 hour, per 1 hour? Or how much is the contribution margin per hour now? That will be 8 times 2.5. And the other one will be $30. So which product is more profitable within the limited resource, which is machine hour?
Standard case.
Standard case.
Standard case. So which should I focus first?
The one that is profitable.
I should focus first on the standard case. And
Yeah.
if there's available capacity, then I can move to the deluxe case.
Yes.
Make sense?
Yes.
Yes.
Sir.
Okay, let's move back to the slides and see what the slides tell us. So after that, we're moving to the contribution margin per the limited resource, which is the machine hours. We can go this direction, or we can go the direction that I show you. First, come up with how many units you can produce within the 1 hour, and then get the contribution margin per hour. The other way is directly go to the 8 contribution margin per unit divided by machine hours, which are required to produce 1 unit, to come up with the contribution margin per unit. But I believe that the way I show you, it's easy to process it. Now, how are we going to allocate those limited resources? For the short-term decision, focus on the product that give you the greatest contribution margin within the limited resource. On the longer term, we have to change the contribution margin per unit limits or remove the limitation of the resources. So, example will be this: increase the machine hours from 3,000 single for 4,200 hours in order to generate more income. In the incremental theory constraints approach is used to identify and manage the constraints. So we have to find the constraints, identify the constraints, and try to eliminate it. Tell me something about this, and we are pretty much over with this chapter. We have 2 more questions to do, and we're done. How can I maximize the profit in the company that's operating in the full capacity?
Highest contribution margin.
per unit limited resources. Yes, that will be the correct answer.
Yeah.
And the next one is the produces various goods and has a limited number of the machine hours available. The following data apply to the product as well. Sales price per unit 960, variable cost per unit 620, machine hours per unit 4 hours. Management deciding whether to limit the production of product A or focus on other products. Which of the following amount should management focus when making the decision? So
A.
what they A. So how did you get the A? You're getting the 960 minus 620. That's going to give you contribution margin for 1 unit. But since you need 4 hours to produce that unit, and the machine hours is your limited resource, you have to give how much is the contribution margin per 1 hour, and you come up with the contribution per 1 hour is 0.85. That's the correct answer. Okay, that was the chapter today. It's a little bit heavy chapter. I want you to go over. I'm going to try to do some questions in the class so you can have idea what's going on. The other thing is, I believe I should have something for us Excel spreadsheet that might help you with your assignment. If I find it, I'm going to post it for you, make it available on Brightspace. For Thursday, please be on time. I'm gonna start going over the questions that I have, so you can practice a little bit about the decision making. And once everybody come, I can give you some ideas about the case. The other thing that I'm gonna do is probably tomorrow, I'm gonna set you up in groups. So you're gonna have your group members for the final case. Final case, you have to write it at home as a group and provide a presentation, but I'm going to give you again more information in the classroom when I see you guys. Thank you for today. Thank you for staying, and we'll see each other on Thursday.